Hello, I am Vadani Ariam. This is one of the videos presentation for a lecture for my course, Basic Accounting for Small Businesses. Financial ratios are part of monitoring budget and cash flow. An economic rate requires reasoning the connection between the two figures and asserting the meaning of that correlation. Financial ratios used to compare the past performance with actuals helps in the forecasting of budget and cash flow. There are 4 types of ratios: profit ratio, efficiency ratio, liquidity ratio, solvency ratio. Profit ratio, it used to indicate the profitability of the business. The gross profit margin, the net profit margin, the return on capital invested in your business. The gross profit margin ratio is the most critical ratio. It is used to assess the relationship between the profit and the sales. Gross profit times 100 divided by sales, that is equal to gross profit margin. The net profit margin, it is not that useful like the gross profit margin, but still can be helpful. The net profit arrived after deducting all the expense apart from the tax for the business. Net profit times 100 divided by sales is equal to net profit margin. The return on capital ratio. From this ratio, a measurement of income generated from the capital you invested in the business. It is also used to measure the revenue generated from other forms of investments in your business. Profit charging interest and tax times 100 divided by total capital employed, that is equal to return on equity. Efficiency ratios. Efficiency ratio divided into 3 areas. Debtors turnover ratio, that is the collection period, how long you are taking to collect the money from the debtor. Creditors, how long creditors turnover ratio, payment period, how long you are taking to make the payments. Stock turnover ratio, average stock holding period. Liquidity ratio, these are measurements used to test the ability of an organization whether it can pay back the short-term agreements. These are mostly used by the potential creditors and lenders to decide whether to extend the debts or loan agreements to a company. Supposing you are in financial trouble and you are going to get the loan, they will use this ratio to check your ability. Current ratio, current assets divided by current liability is the current ratio. Current assets are stocks, cash at bank, debtors, work in progress, and cash in hand. Current liabilities are creditors, loans payable, bank overdraft does not include long-term loans. Quick ratio, it is a sign of its ability to meet the long-term financial commitments and continue its operation in the foreseeable future and to attain its goals. An organization should be analyzed over a time and in the circumstances of the industry the company controls in. Basically, companies should focus on continuing to keep this ratio that maintains adequate control against each crunch for a short-term period, because it is detrimental to any organization given the variables in a particular sector of business, among other considerations. It includes cash in hand and at bank and debtors. Quick assets divided by current liabilities is a quick ratio. Solvency ratio, whether your business is solvent, they have to know. It helps to find the solvency of your business. If the liabilities exceed your total assets, your company is insolvent. That is obvious, anyone knows that. Total assets of the business divided by total liabilities of the business is equal to solvency ratio. Why we use these ratios in a business? It identified positive and negative financial trends in your store. Then we use to compare the financial statements of your company with others in your industry. In addition, it helps you identify the past and present performance and then the weaknesses and strengths in business. It helps to analyze financial statements, which is important for all the stakeholders of the company. Besides, you can easily understand the profitability of the company. Also, when using the financial ratio, you will get to the operational efficiency of the company, whether they are efficiently running the company. That's what it means. I hope you understood the concept in this presentation. Thank you very much for watching my, it will be a video as well. Thank you very much for watching my video. Thank you. Hope to see you in the next video. Thank you. Bye for now.